Hi, my name is Austin, and this is a no BS approach to finance. Today, we're going to take a look at the mega bank JP Morgan, or known as Chase, and their interesting earnings report and what it could mean for the economy. Then we got to go take a look at corporate defaults. And I know it sounds like a boring subject, but it could be a key indicator for the economy, or more importantly, maybe a recession indicator. First, we got to take a look at JP Morgan and their impressive first quarter results, which actually surpassed expectations and set a pace for other banks because they have earnings coming up this week. See, JP Morgan saw a 52% increase in profits from last year, bringing in $12.6 billion or $4.10 per share. This exceeded analyst expectations by quite a bit. The bank also had a record revenue report of $38 billion, up 25% from a year ago as results of the Federal Reserve's rapid rate hiking over the past year. And from this news, the stock jumped 5.8% to $136. Despite recent bank failures and headwinds in the industry, JP Morgan sounded pretty confident about its ability to navigate these challenging times ahead. Jamie Dimon, the chief executive at JP Morgan, highlighted the bank's investment in innovation, and he said they have a fortress balance sheet which allowed them to produce these crazy returns and stand by their clients during a period of heightened volatility. But see, in my opinion, JP Morgan can only be confident because of who they are as a bank. These bank failures made people really scared of these smaller regional banks, and then when they're really scared like they were, now they're starting to make decisions to protect their assets. Well, tons and tons of people have been pulling their money out of regional banks and putting them into what we call mega banks, kind of like Chase and I think Bank of America, which I have also been recommending that this isn't a bad idea. But that's why Chase had record deposits of $37 billion, which is why I think the earnings were so positive. However, in light of the tough economic picture, JP Morgan increased its provision for credit losses by $2.3 billion. So they kind of think that people are going to start defaulting on some of their loans. JP Morgan's consumer and community banking division was one of the biggest drivers of the bank's results, with the profits of 80% up from last year, which is exactly what those consumer deposits, which I was just talking about. So while Wall Street will find comfort in JP Morgan's results, much emphasis will be placed on the economic outlook that Dimon and other executives gave during their Friday earnings call. In his annual letter to shareholders, Dimon stated that the recent bank failures exposed some weaknesses in the system, but expressed optimism compared to the financial crisis of 2008 and 2009, saying we've had 10 years of home and stock price appreciation, and even if we go into a recession, consumers would enter in far better shape than during the great financial crisis. Finally, supply chains are recovering, businesses are pretty healthy, and credit losses are extremely low, Dimon wrote. Overall, I agree with Dimon, but I'm not really sure how useful these earnings calls really are. I don't think it's going to set the tone for the industry, maybe like some are saying. It might set the tone for the top 4 mega banks, but for the whole industry, I don't think so. And investment companies such as BlackRock say that they have profited from the banking crisis. Their CEO said on an earnings call, "I believe today's crisis of confidence in the regional banking sector will further accelerate capital markets growth, and BlackRock will be a central player." Essentially saying that people are scared of the small banks and they don't think there's any better opportunities than investments. And overall, I agree with this, but BlackRock is making this sound like a really good thing. And it's a good thing for them, but it's not as bullish as it might sound. I mean, we kind of have to take these earnings calls with a grain of salt. Earnings calls are not known for their most reliable takes, and they're not super honest all the time. And if this case, if all the money can easily be moved from the small banks to the big banks to investments, it really means that the sector is pretty fragile right now. Another bank run and this conversation could be a whole lot different with a lot more fear. And you really got to remember that just because one part of the industry is doing really well, that doesn't mean a whole lot when it comes to the other sides of the industry. They can actually be really hurting, which is what we're seeing right now. Mega banks doing great, but the regional banks are almost failing. But Dimon is still really right that we are in a much better spot than 2008. They're not bad loans everywhere. Instead, we are fighting an inflation crisis, and according to the last CPI report, that's finally coming down too. Probably not enough to avoid a recession, but at least we're trending in the right direction. And if you had JP Morgan stock during all of this, the stock gapped up about $10 per share, so congratulations. But I still think the banking sector is really fragile right now, but if you want to pick out banking stocks, I think a good choice is JP Morgan, also Bank of America. That would be my top picks. So now we got to move on to the next story. Not a lot of fun, but it's corporate defaults. But stay tuned because this is kind of interesting. This is a question that I have. Is this the cracks that we're starting to hear in the ice for the economy, or is this just like a little speed bump that we're getting through? 37 companies just failed to make timely interest payments on their secured debt in the first quarter, and this pushed the global corporate default tally to the highest first quarter total since 2016. And the last quarter before this that had more defaults was in 2009 during the great financial crisis. So these corporate defaults are seen as kind of a sign of the economy and also the financial system's health. And rising interest rates could impact the investors, stock prices, and even lenders' behavior. So this is something to pay attention to. American countries contributed to nearly 2/3 of the corporate defaults in the first quarter. Credit conditions have further deteriorated in March amid the recent banking turmoil, says S&P. And it's media and entertainment companies, as well as some retail and restaurant sectors, that have seen the highest number of defaults. This includes high names like Bed Bath & Beyond, AMC Entertainment, LendingTree, and it's the uneven recovery from the COVID-19 pandemic and persistent inflation that are driving some towards this credit crunch. So out of the 37 corporate defaults that we saw this first quarter, only 6 of them were due to bankruptcies. Instead, we're seeing more companies that have chosen to ask existing debt holders to take a cut on their principal amount in exchange for moving up in the payment priority. I know it sounds really fancy, but this move is called distressed debt exchange. That's the financial jargon. Generally, distressed debt exchange is proposed by a company to avoid bankruptcy. Maybe they want to improve liquidity, maybe they want to reduce their debt, or to defer payments. So far in 2023, the distressed exchanges are responsible for nearly half of the defaults, which is much different than 2009, might I add, when 1/3 of the 60 corporate defaults were driven by bankruptcies, and only 11 were driven from distressed debt exchanges. So we aren't in the same ballpark as 2009 yet, but we definitely are trending in that direction. And we got to think that we're coming out of the strongest bull run we've seen in a very long time. When everyone was just starting a business, it would make money, buy stocks, it would make money. The pandemic led to record profits and sales. So now we're coming out of that cycle. So yes, it's naturally that companies are going to begin to struggle, and yes, some will not make it. And according to a recent survey by International Associations of Credit Portfolio Managers, 84% of respondents are predicting a recession in the US sometime this year. And the Federal Reserve said in their recent minutes report that they expect a mild recession later this year. This less than ideal economic forecast kind of means that companies are just going to be less profitable, there's going to be less cash generation, and the companies are going to hurt, making them more vulnerable to liquidity crunches and debt defaults. And this recent banking turmoil that triggered the Silicon Valley collapse might further exacerbate the situation. And because banks are going to be more weary about what's on their balance sheet, they're going to be more weary about lending out to people. So expect stricter lending requirements coming forward. This means that it won't be as simple for companies to get their funding for a project, or startups are going to be extremely hard to get their loans. And rates for everyone will also be probably going up. It basically means that we will lead to a slowdown of the economy, and I think we are starting to see those first warning signs, or at least these indicators are showing us that. So my name is Austin. If you found this video helpful at all, please give it a like, subscribe to stay in the loop, and I will see you on the next one.